the Gould Mine podcast.
How have we gone from there to credit unions becoming significant players in the commercial real estate lending space? Especially when we're comparing it now to like traditional banks. So kind of walk us through that evolution.
Yeah, sure. And if it seems like credit unions are relatively new to this business, that's because they are. It was back in 1999, well, 25 years ago now, that the laws changed up that opened this avenue for credit unions. And, I like to think of credit unions as the community bank of 20 to 30 years ago. It used to be every town and had a couple community banks in there. Everybody knew the lenders. You could walk in and see the president and talk to him about your loan. Well, that's us today. So really, once the federal laws changed and opened up, that's where you've really seen that gradual growth. And every year it kind of builds and builds and builds. And as you've seen consolidation in the banking industry with many fewer banks, there's over 2 times as many credit unions in this country as there are banks. So as you've seen this consolidation, as you've seen fewer choices, you've also seen a steady and high growth in the number of credit people who belong to a credit union. There's over 130 million people in this country belong to credit unions. And a lot of them are business owners. A lot of them operate hotels. They operate apartment buildings. And you've really seen that growth and maturation of the credit union industry. My dad belonged to a credit union at his factory, and that's what it was. Credit unions used to be that corner of the factory. I'll give you a savings account and maybe a car loan, and that's where you went. Today, they offer sophisticated financial products. And what we do is really just kind of an outgrowth of that industry. Where today, you're seeing credit unions funding over $50 billion in commercial loans in a year.
What would be some of the advantages to financing? Let's just stick with commercial right now, because that's kind of where we're at. And maybe we can kind of venture off into some of the other stuff too. We'll talk about small business loans and whatnot. But when it comes to financing commercial properties, what would some of the advantages be of financing through a credit union versus, big banks or however else, CMB, whatever, right? Like whatever type of financing strategies are out there, like what would the advantages to credit unions be?
Sure. And anybody who's ever dealt with a credit union knows that credit unions we are a much more approachable, conversational, consultative industry.
Definitely.
We are owned by the members for the members and look to drive and help people's lives out. Well, that's a nice story. But when you're talking into commercial lending, you can put a price on that. And definitely put a price on that. That's nice to have, but it's not going to drive your deals.
Yeah.
One of the advantages that federal credit unions have is no deal can have a prepayment penalty. So, which when you talk to and 4 or 5 years ago, when we were putting money out at 3.25%, that wasn't an advantage because nobody was refinancing those loans.
Yeah, exactly.
You were trying to grab as much of that cheap money as you can. In what I'll call a normal world of 6% interest rates, of 7% interest rates, that's a huge advantage for credit unions. Because what we do, it can be refinanced and move it, and you have the flexibility. Nobody likes to read their loan documents at closing, and many times you're not conscious of what a prepayment penalty is until you go to sell or refinance a property.
Yeah.
And in today's world where rates are a little bit higher, it's not unreasonable to think rates are going to go down 2.5% over the next 1 to 2 years. It's very likely. Whereas with the credit union, you have that flexibility to move. So that's one piece. Then the other piece is really the structure of that credit union industry, where many people don't realize where their money comes for a loan. And when I say that, many times when you're going to your bank, they're not reaching into their checking account, writing a check and saying, here's your money. They're borrowing that money, bringing it to you, and then relending it at a higher rate. Many institutions are like that. And if you look at a credit union, really for every dollar of deposits, they're lending out probably about 85 cents in loans. So they're lending out their own money. And the cost of funds for a credit union today, even with the higher jacked up rates, is about 1.7%. So they can have a very low cost of funds in these times compared what's actually costing them to lend to you. So they can be flexible in terms of the deal structure because they're actually lending out their money as part of the cooperative.
I see. Okay. That makes sense. So, and how does that differ though from, say, for the people that are unaware, right? How does that differ from like a big bank, right? Like one of the big players, Chase, Wells, BofA. Obviously you mentioned, a lot of them are borrowing on their, so it's just arbitrage, right? Is what you've basically described. But is that the only difference? So what are the other, how does that, how does it differ?
Yeah, it's really, when it comes, their cost structure will be higher than ours. And really when it comes to that deal structure of what you're looking for, you can have the conversation with a credit union, on what you're looking for and have a little bit more of an equal footing, because you're part of this cooperative. You can be part of a multi-billion-dollar credit union and go in and talk to their decision makers about how this deal can be structured and what makes it sense for you.
Definitely.
What I would say is, if you compare the experience for the larger deals to that, I'll call it that top 5 to 10 banks in the country, they tend to live in a much more structured world. This is what we can do. This is the box. Here we go. And if you're in that top 10% of borrowers that can just plug into that, it's not a bad experience. For many of us in the middle, you would very much enjoy the credit union experience. And if you're in that bottom 10 to 15% where there's some serious issues with the property, there's some serious issues with the sponsorship, there's not too much to live. We tend to live in that large middle that most of where people are, where we can talk about. And we're also tend to be much more regional lenders. We do have people that work nationwide, but we're also not going to, if you have a deal I'm in Pennsylvania. If you have a deal in Erie, Pennsylvania, we're not going to say, well, we don't lend in Erie, Pennsylvania. We lend in regions and those communities of where they're at. And sometimes those are states, sometimes those are multi-states, or sometimes those are those second and third tier markets where the big banks just stay out of, to be honest. They're interested in lending in large properties in a downtown area with the big suburban areas, and that's what they do.
I would corroborate everything that you're saying, right? So the flexibility component of the credit unions and their ability to play in areas in buy boxes that a lot of the bigger banks wouldn't, right? Like the bigger players wouldn't. It allows you, like you said, right, to kind of like cover a broader range, I'd say, of buy boxes than your cookie cutter, big bank, insert big bank name here, right? Because a lot of them, like you said, are cookie cutter, and that it does very much feel that way.
Yeah. And if you're buying a 400 or 500 unit apartment building and can qualify for Fannie or Freddie financing, that is always going to be your cheapest and money available. However, that's a small box. Not all deals can fit in this box. And that's really where we come into play.
So let's say we've got a real estate investor, they're interested in working with a credit union. What are some of the key loan requirements that they should be aware of walking into like someone like yourself?
And this is the area that I would say we are the most boring at. We're going to need, it just like anybody, we're a regulated financial institution. We're not doing hard money loans where we just say, give me the address and I'm going to give it to you at 15% overnight. We are a regulated financial institution and I got to show you can pay me back. For sure. So that first deal, it's going to look pretty similar to everybody else's deals. We're going to want your financials. We're going to want the plans, projections, that package that you give to everybody else. We're going to want that same financial package to everybody else. But that first time you come to us, the easiest thing and the worst thing we can do is just take all of that, put it into the machine and come out with an answer. What we try to do is we want to have that conversation to understand who you are. We want to understand this deal, but we also want to understand where you're going. We're much more of a relationship type lender than just trying to crank out deal to deal to deal, because that first deal, with somebody tends to be the hardest. And we want to make sure we are helping you where you're going and not just where you're at today, trying to get this deal closed in the next 45 days. So that's that first piece where sometimes people are taken aback because yes, we collect it, but let's talk so that we're understanding the story behind you and your business to make sure it's a fit for us. Because really, we're lending out your neighbor's money. People have, we're not lending out Wall Street money. We're lending out your neighbor's money. So we want to make sure we're good stewards of that money. So I would, compared to the traditional box, we're pretty close, but it's really that experience and relationship and the terms that we can offer that put it over the top compared to some of the big banks. I've never had somebody say, I have a Chase credit card, so I'll say Chase. I've never had somebody just say, oh, geez, I can go in and I have a relationship with Chase where I can talk to somebody. And particularly where maybe you have to get over a hurdle or there's something that we got to work through on this deal. Well, let's talk through it. Whereas in that big bank, here it is. This goes through the grinder and out comes an answer.
Yeah, it's interesting. And even from when I was getting started in business and kind of like in my early years, I was always kind of taught that the best strategy is to, find a local regional bank and or credit union and start to build a relationship with them early, because there are things that you can get done with local banks, local credit unions that you wouldn't be able to get accomplished with like a big bank, just because the relationship aspect is far less and or non-existent. Let's speak to that a little bit, because you kind of touched on it, right? But like, am I far off there? Because that's more or less what you're saying is what I'm hearing.
Yeah, exactly right. Credit unions are run by a board of members who are elected by the membership every year. So they're and we're not trying to jam through an earnings per share every quarter. And credit unions, we are stable and in the marketplace versus trying to pump up an institution to sell it to some bigger institution. So it's a longer term vision outlook, which I think, if you're just in for high rises in New York City, we're not the people for you. But for the 98% of America, kind of in that middle, for the real estate investors, our biggest transaction on our book is up to $40 million. So we do help out people across the spectrum in their community to get that real estate investor. A typical start for us is many people who have a job. Maybe they're a successful executive and they want to get into the real estate investment business, or they have a blue collar job and want to start buying smaller units. That is a very common scenario for us, is that they have that relationship with the credit union. And that first deal is really that one that we can help people out with, because we know you and you know us. And like you said, you got good advice into form relationships with those local lenders, because it's valuable.